the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors and companies to watch. But as always, a quick recap of some key movements. While Singapore shares were little changed today, as investors put the US Federal Reserve's decision to hold interest rates behind them. Now, the Straits Times Index was up a marginal 0.05% at about 1 p.m. Singapore time to 3,932 points, with a value turnover of 512 million Sing dollars in the broader market. Now let's take you through how the Singapore stock market fared for today. The STI closed down 0.1% in the red at 3,926 points. In terms of value turnover, we are looking at 2 billion Sing dollars. Gainers trailed losers 234 versus 284. Top advances for today, we've got for you UOB, Yangtze Shipbuilding Sing dollars and Ascent Bridge. And top decliners for today, we've got for you GMH USD, New Incorporation USD and ASUS. Now, in terms of counters to watch, we have Top Glove after the Malaysian glove manufacturer reported a net profit of 30.3 million Malaysian ringgit, or around 9.1 million Sing dollars for its second quarter ended February, reversing from a net loss seen a year ago. Now, elsewhere from China's import of US cotton, cars and some energy products plunging in the first 2 months of the year, to Japan's core inflation hitting 3% in February, more international headlines remained in focus. And also on deck, more on Nike's latest earnings under its new CEO. Well, lots to watch, and joining us on the line on Friday is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, how are you?
I'm good. How are you, Tian Tian?
Good, but I think it's a chaotic day for markets as well. I mean, Europe, we're just looking at Heathrow Airport and etc. A lot of things to track for today. But Ben, let's start with the Singapore stock market first, yeah? How did the STI fare today? Any surprises when it comes down to the biggest movers, say Prudential? Because Prudential yesterday announced a joint venture with India's HCL Group's promoter company, Varma Sundari Investments Delhi, and that is to operate a standalone health insurance business. Anything to note on this front?
Well, the SCI performance today was more or less in line with the US market, so we're down slightly, but very slight, as compared to the European markets, which opened pretty much lower. I think the biggest surprise on the STI index was actually Yangtze, because Yangtze is up $2.47, about more than 5%. Can't really see any fundamental reason for it, so it's probably a technical rebound because the stock has been very much oversold recently. And coming back to Prudential, so I think the Prudential tie-up with HCL Group is actually a very smart move. So you look at it from a macro perspective, India has got a population of 1.4 billion people, slightly bigger than China. While China has got a huge growing population problem, India has got a very large and fast-growing middle class. So in some of the regions in India, the state-provided health insurance may be spotty or even non-existent. So, using the playbook that Western insurance companies have used in China, Prudential is following the same path in India. So private health insurance is definitely a growth area to serve the middle class. Because of deficiencies in the state-owned insurance packages. So, with Prudential getting in right now is actually, via tie-up with a local player actually is good because it reduces risk and, it plays the strength of the partnership. So the local player can be the front, people actually selling on the ground, while Prudential provides the back office as well as the risk management and capital. So I think it's all a good idea for both companies involved.
And zooming in on some of the other companies to watch, right, Ben, we've got here Fuyu Corporation. After the firm said it had received a new request from its largest shareholder, Victor Lim, to table resolutions to oust and appoint directors to the company's board at its upcoming AGM, annual general meeting. I understand this is not exactly new, so how would you read into the move at SIAS?
Well, I mean, the context here is that the company itself, Fuyu Corporation, reported a net loss for 2024, and it's mainly because of write-offs or impairments because of its investment in Fuyu Supply Chain Solutions. So the parent company has stated that the subsidiary, Supply Chain Solutions, had made one or more unverifiable payments to third parties. So coming back to the current situation, the company itself, Hui Corporation, actually now has got a 4-member board. So the majority shareholder, or rather the large shareholder, Victor Lim, wants to remove 2 existing board directors and appoint 3 new directors. So then the new board, if it goes through, will have 5 members, 3 of whom would have been proposed by Victor Lim. So this is, I guess in this sort of situations, this is quite a textbook example of trying to take control of a board. And, generally this is a prelude to forcing changes in management and strategy. So the company itself is already not doing well, and then there are some questions about what the subsidiary has been doing. So this is good from that perspective, but if you look at it, changes in the board makeup do not actually change the company's fortunes on its own. So if you take an example out of the US, where you've got activist investors like Bill Ackman, so these guys, they want to take over the board, but they also usually come with a plan, as in they know what the problem is and they have a proposal. That is actually missing in this situation. So although Victor Lim owns about 30% of the outstanding stock, the vast majority are people like you and me. And what's happening now is that these guys, they want to make changes to the board, but what is in it for the rest of us? I mean, how does this actually change the company for the better? So there needs to be a plan. That's what we're looking for.
Okay. Now, another company to watch, Ben, is Top Glove, because the Malaysian glove manufacturer reported a net profit of 9.1 million Sing dollars for its second quarter ended February. Now, this is a reversal from a loss we saw a year ago. What do you think is the outlook for Top Glove amid shifting supply chains and trade diversions from U.S. tariffs on Chinese glove exports?
Well, on a net basis, U.S. tariffs on Chinese glove exports is actually a plus for Top Glove, which is actually a Malaysian company, right?
Yeah.
So given time, Top Glove is probably going to take a little bit of market share in the U.S. at the expense of its Chinese competitors. But the challenge is that this industry is very, very competitive. I mean, the sector dynamics, right? So the nature of the business is that, these are disposable gloves, right? So you need to sell millions of this at super cheap prices, at super low margins, right? All the while being beholden to raw input prices like rubber and, so on and so forth. And traditionally, if you look at globally, like, this is the kind of business that is dominated by China because they do things at massive scales. They have very cheap input prices, so on and so forth. So, although this is going to be a plus for Top Glove temporarily, but it's still going to be a very uphill task to try to, hang on to the crown because the Chinese competitors are super, super aggressive. Already, if you look at the other big market, which is Europe, the Chinese competitors have already adopted very, very aggressive glove pricing strategies, trying to, take over Top Glove's turf. So it is not going to be smooth sailing. It's going to be, the fight continues. Top Glove needs to continue fighting.
Okay, so Top Glove will continue the fight to be at the top. So let's talk more about...
That's a good one.
Let's talk more about trade, Ben, because if we look at China's imports of U.S. cotton, cars, and some energy products, they all plunged in the first 2 months of the year. No surprises there because U.S. President Donald Trump started imposing tariffs. Beijing retaliated. If we look at a Bloomberg analysis of data released yesterday, Chinese purchases of cotton fell almost 80% on a yearly basis. Imports of large engine cars down nearly 70%. Purchases of crude oil and liquefied natural gas dropped more than 40%. Question for you, though, how much of a spillover impact do you expect to see in Chinese equity markets as a result of that?
Okay, so not a very straightforward answer, but I guess the knee-jerk reaction in equity markets is already there. So the trade war is bad for everybody involved. But if you look at it, the main narrative driving Chinese equity markets is not just the U.S. tariffs, but is really domestic, right? Because they've got poor GDP growth, compared to historical norms. And they've got a huge problem with deflation, which is negative inflation. So if you look at the Chinese CPI reading for February, that was actually a negative 0.7. And, China buying less U.S. exports, U.S. products is really a problem of low domestic demand, simply because the economy is not doing well. So they're going to be buying less exports from the U.S. And of course, the minor headlines that they don't like Trump, okay, so they can, source most of these agricultural products from Latin America and Europe, so on and so forth. But the fact is that the Chinese economy is not growing as fast as they want, so they are importing less stuff. So if you look at it that way, right, the Chinese stock market performance is really a reflection of market sentiment. So it's really around whether or not the Chinese government can turn things around with new policies to spur economic growth, and not so much about the U.S. tariffs. So that's a factor, but not really the main narrative here.
Okay, now if you're just tuning in, we're now in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. While staying in Asia, Japan's core consumer prices rose 3% in February from a year ago, so staying above the central bank's 2% target, also reinforcing market expectations of further rate hikes. What do you think the latest numbers mean for the Japanese yen and consequently Japanese equities, though?
Okay, this is a classic case of good news, bad news.
Yeah.
Okay, so the good news is that the consumer price pressures are entrenched. So in other words, inflation is here to stay, which is, a good thing, given Japan's 3 decades of lost economic growth and stagnant wages. So the Bank of Japan has succeeded in that mission. The challenge is that the reading is a little bit higher than was expected. So the Bank of Japan is probably going to hike interest rate a little bit in the next in the next meeting. I believe end of April, early May. Interest rate hikes tend to strengthen the country's currency. So this is probably going to lead to a little bit of strengthening of the yen. That's not too bad because the yen has fallen down quite a fair bit. But the stronger yen actually hurts profits of Japan's largest companies. Just like the S&P 500, the Nikkei 225 or the Topex 500, right? Dominated by the big caps in Japan. These big caps actually generate about 45% of revenue outside Japan. So if the yen appreciates, then of course people in outside of Japan will be buying less Japanese products, and they will hurt the big caps. But correspondingly, a stronger yen will make imports cheaper for domestic companies in Japan. So it could be that, big caps are going to suffer a little bit, but the small and medium caps in Japan may actually benefit from the higher yen because of cheaper imports.
And, further away, Nike's earnings were out overnight. Now, its results surpassed analysts' expectations, of course, as its new CEO's turnaround strategy began to take hold. So if we look at revenue, that's down 9% to $11.3 billion for the quarter ended February. That is, of course, better than that 11% drop that Wall Street predicted. Any thoughts on the latest numbers under the new CEO, who is said to have, worked his way up from the bottom all the way to the top?
Well, Nike's problem before the new CEO took over, right, was really because it's got a very large and aged inventory. So it's just like having a shop with, last year's model and nobody wants to buy it. So the new CEO, Elliot Hill, I believe, he correctly identified the need to right-size the inventory, but this is going to take time. So, for this kind of products, retail products, if you want to hard down your inventory, what you really need to do is to give the retailers discounts, right? And discounts, will go so far in increasing demand for your products, but it's going to take time to clear out the old inventory. So correspondingly, what's going to happen is that, and the company has said this itself, it's going to probably experience a few more quarters of not so good revenue, not so good profit. So, but it's going to be temporary, right? So the current weakness as well as the, in both revenue as well as gross margins is probably going to be temporary. But we are probably going to be seeing a couple more quarters of poor performance until the old inventory is cleared out, as well as when the new models come in. Now, correspondingly, Elliot Hill has also stated that he wants to focus on rebuilding relationship with retailers, rolling out new shoe models. He has, reorganized the marketing campaign around classic Nike campaigns rather than the more digital, clicky kind of ads. So, in my view, that's going back to the strengths of Nike before the last few years, when the company focused a lot on pushing out very samey kind of products every week, every month. So he's going back to the original playbook. And I think that plays to his strengths because he worked from the ground up, right?
Yeah.
So he saw the company grow. He knows what works. So it's a good thing that the board brought him in to right-size the ship.
And finally, before we let you go, Ben, I'll leave you to pick what you want to talk about this time around. We can talk about Tesla recalling most of its Cybertruck to fix an exterior panel that could actually detach while driving. Or we could talk about Zara opening that new style Asian flagship store in Nanjing with a cafe and a content creation studio inside. Which one stood out to you today?
Okay, I'm going to leave Zara to my wife, but I know she's out for dinner, so I'll take Tesla.
Okay.
All right, so Tesla, you have got these external panels flying off. So I read a couple of studies about it. It's not really a life-threatening thing unless you are the car behind, it slams into your windscreen. It doesn't really affect the operation of the car itself. So the problem itself is, my reading of it, it's not critical, it's not life-threatening. It's not a problem with brakes or engines. It's not even like an EV catching fire on the Bukit Timah Expressway, right? So those are life-threatening. The problem is, of course, the timing is very bad. So if you look at Tesla's shares, or rather sales and shipments figures in Europe as well as China, they have essentially fallen off a cliff compared to 2-3 years ago. In China, of course, it's a very business-related reason. You've got very strong competitors like BYD. So they've got much cheaper vehicles to compete with Tesla. The technology could be better. The styling is as good as, if not better than Tesla. And of course, you can already see in Singapore, right? So a BYD EV is like $200,000 with COE, but Tesla is, of course, like 50% more. And of course, it doesn't help that Elon Musk's own, branding is damaging Tesla, the company. So his involvement in the Trump administration, his personal politics, his behavior. So the company itself, the share price is down about 40% since January. So on the face of it, external panel flying off, that's a problem, but it's not the biggest one. The company has got so many other big problems that they really need to fix, and which they're not really. So this is bad, but not the worst thing that's happening to Tesla right now.
Okay, thanks so much for the insights, Ben. That was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.